The equities market is sustaining the positive momentum as investors renew bargaining interest in bellwether stocks. And I have Chinma Ukadike, Consumer Goods Analyst at Vetiva Capital. She joins me now to discuss the fundamentals driving the markets today. Thank you so much for your time today, Chinma. And let's first look at what's driving sentiments today.
Well, normally we would see that, speaking specifically to the consumer goods sector, normally we would see that with the release of Q2 earnings, a lot of investors reward the stocks that have been that have performed well. But so far this quarter, we haven't seen such positive sentiment. I think that as at last week, we had seen a lot of bearish sentiment come through across the sectors. So I think what we're seeing now is just investor sentiment remaining stable from the bearish sentiment we had seen before. So it now looks like
so much of dividends coming in that space.
Well, we have seen some dividends. So, for example, we've seen Guinness coming with 7.41%, 7.41 naira, which is very supersized, given that last year they had declared, I think, 46 kobo. So we haven't really seen that affect Guinness's share price, even though we can argue that the share price is really very high at the point at this moment. So,
yeah, looking broadly at the performance of the sector, we're seeing that year to date it's down about 2.7%. We're even looking at more or less last quarter, more or less Q2 is down about 8%. What would you say are some of the issues that the players here are contending with?
Oh, a number of issues. Looking firstly at top line, we had seeing that at least in Q1, going by GDP numbers, volume had risen. Looking at the year-on-year volume growth for the food and beverage sector. However, listening to management for some of these companies, they've said that volumes haven't really been that great, and what has really been supporting revenue has been pricing, which they had to take. They were forced to increase due to rising cost of inputs and all of that. So first of all, we've seen declining volumes. We've also seen rising cost pressures, with the Russia-Ukraine crisis that's ongoing. Energy prices are up, input commodity prices are up. So that's also affecting them. Also, if you look at the added impact of FX pressure for those companies that would have to import some of these commodities, talking about the wheat players, the sugar players, and in some cases, the brewers that have to import barley and all of that. So those are some of the issues that have affected them. And then what's more, if you are one of those companies that have dollar-denominated debt, then, with all that's going on in the FX markets, you're kind of in a bad position.
All right, but how would you say the progress has been generally across the sectors around backward integration?
I think we're seeing a lot of progress. So far, for the sugar producers, I think they have been very active in that space. We've seen players like Dangote Sugar, Boa Foods, and flour mills really invest in cultivating sugar and milling plants because they have to, at the moment, given that we import almost about 90% of sugar that is really refined in Nigeria, and with the impact of the FX problem, it's kind of a no-brainer to have to do a local sourcing strategy at this point. So although I would say it has been stalled for a bit, for example, the National Sugar Master Plan that has been ongoing for about 10 years now and should expire in, I think, next year, hasn't really done much to move the needle. Part of the problem, I think, would be smuggling of sugar, of unlicensed sugar through the borders. 2020 was quite a good year for them, 2019, 2020, when the borders were closed. But with the reopening of the border now, we may start to see them revert to such challenges.
But looking broadly at the earnings, from across all the different sectors here, playing out here, would you say it has been largely impressive compared to the challenges that we're seeing play out this year?
Yes, I think it has been very impressive. For example, looking at the brewers, across the sector, well, mostly for Guinness and Nigerian breweries, we've seen supersized earnings coming from those players. However, we can say that most of it has come from the increased pricing that they've been able to implement this year. You know, for example, for Guinness, which operates in the premium space in terms of their spirits brand or spirits segment, we've seen double-digit pricing growth in that segment. So that has been really what has supplemented their earnings progress. For Guinness, for example, PAT grew from about 1.3 billion to about 15.7 billion, which was, you know, very significant. For Nigerian breweries as well, I think they grew from about 8 billion to about 18 billion, which was also very significant. For international breweries, the story is quite different, you know, because they have some other operational challenges in trying to gain scale so that they can cover their margins. But so far, I would say it has been very impressive. Aside that, looking at the food producers, Nestle has shown impressive numbers as well. Dangote Sugar as well has shown impressive numbers. And if you go across board, we can really come to that conclusion.
But when you take off the top line and the bottom line numbers, what other areas would you say, yes, they've managed to do so well? Is it in cost cutting or more or less where?
So margins have been great generally across the board, say for a few players. And like I said earlier, it's really down to pricing because costs have not really eased. You know, if you add what is happening with the pricing themselves itself and FX components of those costs. So what has really helped them to really record such impressive margins has been their pricing power to, you know, increase pricing so far.
Not even higher volumes?
Well, volume has played a role, but, you know, I think more emphasis has been placed on pricing.
All right, Chinma, thank you so much for that analysis. Chinma Ukadike is a consumer goods analyst at Vetiva Capital.